right. Well, welcome to our session on how to screw up the automation of your loan originations. It's a survival guide for all lenders the world over. So, good day. I'm Chris LaBruna, Chief Revenue Officer here at Trust Science, and I'm joined by our founder and CEO, Evan Chrapko, and our Chief Data and Analytics Officer, Jeremy Mitchell. Welcome, gentlemen. So, as we all know, lending is a multi-trillion-dollar industry, which is ideally suited to automation because its language is numbers. The inevitable result of technology in lending is that loans officers are becoming an endangered species. At the same time, in most of the developed world, the industry is highly regulated with many consumer protections and therefore lots of ways for lenders to go wrong, lots of moving parts. So to get us started here, let me throw it over to Evan to talk about the complex playing field and some of the interrelationships to consider. Evan?
Thanks, Chris. We've been at this a while now as Credit Bureau Plus, offering a turnkey service. We'll break this into 10 different topics. So I'll lead by highlighting the environment that Chris just mentioned is very complex and a lot of interrelationships to consider. So the way to go wrong, point number one is that because the modern economy is complicated and highly integrated, lenders have to remember that they operate inside of a massive ecosystem with partners that are both upstream and downstream, and that doesn't come as any news or surprise to any of the audience here. But it's not always, what we've seen is that it's not always the case that you say your lead gen and mail houses have been considered or integrated into your decision system. If you're an automobile lender, your dealerships, you're probably on dealer track if you're an indirect auto lender, but the dealerships themselves are the last mile to the consumer. And you'll hear a little bit from Jeremy right at the very end about that particular piece, even though you don't necessarily think of yourselves as operating direct to consumer. Then there's servicing partners if you're outsourcing collections or the servicing and recovery parts of your business. For those who securitize their book or for loans that are already in flight, there's another part of your business that's got to be part of the upfront considerations, even though we're talking about choosing something for doing originations. It's got to span across a complicated network of different players, both upstream and downstream from you. And then there's M&A considerations, especially regarding due diligence and any of the post-purchase integrations issues and risk or managing portfolios going forward in time that were originated differently. You want to be able to be on top of that and reporting to your relevant regulators or governing authorities. So if you're truly automating your loan originations, you truly need to ensure compatibility and integration with things that are going on before the origination step and also things that come downstream after you, after originations and after you as an organization. Those would be my thoughts. Don't ignore the fact that there's a complex tapestry here.
Right on. So given this complex ecosystem, Jeremy, talk about the importance of data.
Yeah. So obviously, if you want to solve your business problems, you got to have data to back up what you're trying to do and provide direction with where you need to go. It's like trying to bake a cake without having any ingredients, right? So you're not going to do very well with just having a bowl of water. You can't serve that up and say, hey, look at this wonderful cake. And so you need that data to be able to support what you're trying to solve for, and provide that direction of what are the right activities and strategies that you need to do. Now, the first thing you need to ask yourself is, do I have enough data to accomplish what I'm trying to do? And that can be your own internal data, or if you don't have enough internal data, how can you supplement that data in the outside world more pertinently, the data that represents what you're trying to do. So similar product types, similar consumers that you deal with, similar geographies that you work in, et cetera. Those are all important things to consider when trying to gather enough data. And then secondarily, it's about having the right data to solve for your business needs. So for example, if I'm trying to figure out who's going to pay my loan back, then I want to gather all the information that's pertinent to why somebody would or somebody wouldn't pay the loan back. And so that, talks to consumers' ability to pay, their willingness to pay, and their capacity to pay. And so in your effort to gather data, you should be looking for all of those three categories that help you determine the full picture of a consumer and whether or not they will repay the loan or not. So that's sort of the second piece is, making sure that you're gathering all the relevant information from all the different perspectives that would help define what you're looking to solve for. And then finally, it really is what is the business problem you're trying to solve for? Can you clearly define that, and do you have the data to back that up?
Okay, so continuing with you, Jeremy, and our theme of how to screw things up, how does one avoid selecting the wrong targets to optimize for?
Well, I mean, so the first thing you have to understand is what really affects your business, right? Is it purely I need someone to pay the loan back that I give them? Do you have other considerations that might not require such a finite view? In other words, if you're selling or you're providing loans that are backed by assets, then those assets have value, and it might be that you just need someone to pay the first 12 or 24 months of that loan to be profitable, and then what happens afterwards again is what I would call icing on the cake. And so that might be a reason to change the target. Or what you might find is it really has very little to do with, let's say, if you do a lot of repeat business with consumers, it's very little to do with the initial loan. It all comes back to, can I get repeat business? How much of a long-term relationship can I have? Does this person have a higher lifetime value? And so really understanding your business to define what's the right target that you want to address is key. If your business really is driven by initial down payments and the first 6 months of the loan, and you choose a target to analyze that's is someone ever going to charge off, for example, then that's like creating spaghetti and putting chocolate sauce on it. Just because it has the word sauce in it doesn't necessarily make it the best ingredient that you want to do. So you want to make sure that you're using things that are relevant to your business, and don't get stuck in the tradition, right? Which is, for auto, for example, it's like, okay, I want to look at people who are 60 days or 90 days past due or worse in the next 24 months. And that's sort of the traditional target that people look at. But I would ask the question, does that make sense on your business? Do you have issues on first payment default, for example? Do you have issues on high repo with highly depreciated assets, right? So think more broadly of what's really affecting your business and set those targets accordingly.
Okay, so Evan, there's a lot going on here. Talk about flexibility and the ability to respond to change, regulatory or otherwise, in this massive ecosystem.
Yeah, actually, so this topic number 4 on where we see folks having gone wrong is not keeping it a very high priority, that whatever you select or however you build your strategy and internal systems or processes are inflexible. So the inflexibility would be the way to screw up considering how to do or automate your originations. And we'll hear a lot more about the platform a little bit later, but mainly the flexibility point um, about, so picking up where Jeremy left off, that you got to get the right targets. You've got to also acknowledge that in the real world, the targets are going to change. That's the only death and taxes and change is only things you can count on. And your system needs to be able to respond to those. They're both internal. So maybe your board of directors or your funders are imposing something on you that fundamentally changes what you're optimizing or what you need to do tomorrow. Or, for example, there are shocks to the system like the one that everybody woke up to in March of 2020, and the economy is getting locked down worldwide, and the price of oil going to negative dollars a barrel. So you've got to think beyond simplistic probability of default, and even beyond conventional asset ownership constructs. For example, if you're an auto lender, what do you do when people want to buy as a group shared car? What do you do when electric is the asset and the depreciation history isn't yet quite figured out on those vehicles? Or simply now, a lot more of the pay for mileage or pay for trips or pay for rides, and the corollary there is that you're having buyers who look a lot like consumers but are actually making a business out of the fact that they own that one personal vehicle, whether that's through Uber or Lyft or other ride sharing services. So you may not be financing the purchase of steel and rubber at all. Does your system accommodate that or have the flexibility to accommodate that into the future? And then just in terms of the kinds of questions you want to be asking through the life cycle of a loan, you've got to be thinking beyond the fire and forget mode of the bigger, older, decades old credit bureau systems or technology and tools like that. It's not enough to receive a score for a given question and maybe a big file dump raw or otherwise. You've got to be in an infrastructure that can be conversational and live through or help you through the whole life cycle of the loan, because things are going to be changing again, whether imposed from within or by the outside environment and regulators or economic cycles. Make darn good ensure that you're on something that's flexible, inherently capable of itself being adjusted, calibrated, and automated.
Now, Jeremy, that's all well and good, but aren't there challenges with being compliant in a world that's quickly ratcheting up on consumer protections and the plight of the and underbanked?
There definitely are challenges. The way I like to look at it, though, is the challenges come when you're non-compliant, right? So how do you live with a roommate in a 6 by 10 foot room? How do you deal with eating bland food 7 days a week for 6 to 10, if you will? So what we want to make sure is that we look at compliance as a necessary thing, something that will make your business better. And so what you want to make sure that you're considering is um, how um, how are you meeting the regulatory requirements for your industry? Do you have a platform that enables you to easily monitor what's going on with your scores and with your strategy? Are you exhibiting fair treatment to your consumer customers? All these things are important, and so you want to make sure that you are positioned so that you can have the ability to monitor. And if done in an automated fashion, the challenges are very simple, and something that can, again, like I said, make your business better, because as you're monitoring for compliance purposes, you get to see how your business is trending, how your consumer base may be adjusting. And again, another real important piece of compliance is the ability to do testing, right? So if I'm going to try new strategies, if I'm going to create new products, how is that going to play out? So that I think that both, again, makes the ability to demonstrate to regulators and auditors that you have a complete grasp of your business, but also helps drive better business results because you're actively seeing what's going on with your customer base.
Right. And when it comes to compliance, most importantly, we all want to stay out of jail. So Evan, discuss the credit ladder and building a system which allows for expansion from one's current position or positions on the ladder.
Right. So this item number 6 or area number 6 of where you can box yourself in when figuring out how to automate your originations is that you get committed into a system that can't move up and down the credit quality ladder. People in their lives, I say telescope, or they're on an extension ladder. They may start out as subprime, but the modern consumer wants to be with a lender who can improve them along conventional measures or for other purposes like insurance outside of credit and so on. So if you're a subprime lender, make sure that you're working with vendors who will ask or insist upon getting your Metro 2s, or that you furnish the performance every month of what's been happening in your loan portfolio. Or maybe you're a prime lender and you're used to that already anyway, but now your board is seeking higher yield without blowing up the risk. Make sure that whatever you've chosen to do or however you've chosen to automate your originations is something that will work down the credit quality ladder, down deeper, surfacing up the invisible primes. In any case, don't lock yourself into something that binds you to one end of the spectrum of credit quality or the other. The one-trick ponies when it comes to that prime versus subprime chasm are going the way of the dodo bird. We've even watched it in the last 14 months where consumers have dramatically changed what their perceived creditworthiness is for lots of reasons, understandable and also more indirect and intangible, like stimulus checks, and then vaccines and virus variants and so on. It's just chaos out there. So whatever it is you do, I'm pleading that you're on something that's very, very nimble, very, very flexible, and can go work seamlessly up or down the credit quality ladder.
So Jeremy, continuing with Evan's theme of flexibility, adaptability, and leveraging technology, how does one build the proper foundation to enable such?
Yeah, so I think the first aspect is with your platform, right? And so in the assessment of consumers that are wanting to do business with you, there is the need for, as Evan had mentioned, that flexibility, but to cover on a lot of the topics that we've already discussed around data and compliance and those sorts of things. The reality is that as you are gathering data, as you collect data from across number of sources, as you're thinking about, let's say, moving up the credit ladder or down the credit ladder, the reality of it is you don't necessarily need all the same data for every individual. Certain consumers you can make reasonable decisions with using a standard set of data. Other consumers, whether that be emerging consumers or consumers that don't use credit in the traditional sense, and you need to bring in alternative data sources into the mix, then you need to have a platform that enables you to do that, where you're not stuck with having to pull all the data in on everybody when you know you don't need it. You also need a platform that allows you to make the best decision along the way. And so what I mean by that is you might have a workflow that that has you assessing the consumers at a number of different decision points. And so having a platform that allows you to do that seamlessly, recognizing that it is the same consumer, it is the same application, all those things are important so that you are providing a good consumer experience. as well as making the best decisions and for the optimal cost that you can. And so having a platform that enables you to um, uh, uh, pull in data at different points in time, make multiple decisions at different points in time, but is there throughout the process, I think is the ideal situation.
Okay, and now for the buzzwords and acronyms. Evan, is AI and ML still considered bleeding edge?
No, the entire world doesn't revolve around software anymore. Mark Andreessen famously said software ate the world, but I think now AI ate all the software. Still, don't become enthralled by AI either. It's no longer cool or special, just table stakes or the cost of entry into any kind of modern system, particularly if we're talking about actually automating originations or the jobs of loans officers and loans adjudicators. AI and ML are mainstream now. Pretty well-developed tools and techniques and ways to evaluate the efficacy of these of models built using AI and ML. Some of it is counterintuitive, so some of it does require breaking old habits or understanding this new world of capability. But I'm fond of saying that AI and ML is so 2019 now. But if a vendor is going on and on about this, or if all they offer you is tools to supposedly apply AI, like adding salt at the end of the recipe, then run, don't walk away. They don't know what they're talking about. A complete solution brings to bear everything that Jeremy just mentioned about the platform being intelligent and conversational and marshaling in the right data for the right app, on an applicant by applicant basis, and being able to get your strategy incorporated, even as that strategy might be changing. And it has to be easy and fast to start using it. And so that's just next to impossible to achieve with scorecarding methodologies or older techniques or tools like linear regression. Preferably, if you are casting around or evaluating alternatives, then because it's a big investment. What we're talking about is going to cause everyone to pay attention, from the board or shareholders on down, including your employees too and customers. But preferably for that kind of investment, you want to be with a platform or vendor that's got a ton of patents in your jurisdiction of operations, or ideally around the world. Why? Because you don't want some other vendor to come in later and upset your apple cart after you've made a big, huge investment on someone who's not necessarily entitled to, doesn't have the freedom to operate against that person who does have the patents.
Okay, so you can get caught flat-footed by being too enthralled by AI and ML. Interesting. What about anything out there that is invisible or a threat technology-wise?
We're all keeping our eye over the horizon. Appropriate image in your background over there, but the future proofing of what you do, and referencing the earlier conversation that consumers have choices. One of those choices that's received a massive boost over the past little while is the mobile phone, or the virtual way of doing business. Several of our very large customers are looking at either deprecating or not putting terribly much more investment into bricks and mortar and doubling or tripling down on the online lending. Millennials and the new to credit or new to country borrowers are gravitating away from bricks and mortar. They're already on their mobile phone. And if software ate the world and AI ate software, then the mobile phone is eating bricks and mortar. Credit being offered on the spot in that instant gratification economy. Amex used to say, or maybe still does, don't leave home without it. The millennials are saying don't leave home, period, or certainly don't leave home without your phone. So your system, or whoever you use to help you automate your originations and then manage your book of loans, and for that matter, every vendor you use has got to have an on-ramp into the future, or a way of a real demonstrated ability to talk about it and execute into the future around things that are coming. And that in this particular field, so technology, that is a blockchain infrastructure. So the way everyone was talking about the internet 20, 30 years ago, blockchain will inform or underpin a lot of capabilities that may not have room for or a place for the big old conventional hub and spoke models for data, where you've got big, huge repositories of data and everyone gets access just by plugging in. Blockchain will let your mobile phone be a personal credit bureau in a manner of speaking. So for the purpose of the assessment, at the time of the assessment being made, with the institution needing to assess you, that's who gets the data, and then the session is ended. None of this persistent data that's subject to big, huge breaches and hacks and ransomware and so on. So we are going to see that in the fullness of time. It's not a today thing. Again, if anyone's beating that drum incessantly, maybe not appropriate, but definitely they better, whoever vendors you're talking to, better be able to talk about it intelligently and demonstrate chops in where the world is going, not just where we are today. And obviously, you don't want to be where everyone was tomorrow. Remember, for all of your vendors and yourselves as lenders, change at first comes slowly, and then it comes at you, or it comes at the old big conventional credit bureaus very, very quickly, like a freight train. And sometimes it's not easy to see that coming. Be with someone who's paying attention beyond the horizon.
So taking that and stepping back for a second, there are borrower considerations here. So in the new post-COVID landscape, maybe it's not enough for lenders to focus on what's behind or within their own firewall, but even to the point of going all the way down to the mobile phone. So Jeremy, what about direct to consumer?
Yeah, so direct to consumer has taken on a new aspect these days, specifically because a lot of consumers now want to determine what they can afford, determine any financing they can get, sort of have an expectation of what they have to look forward to before they walk in to do a purchase activity, whether that's an automobile or buying a home or anything else. They'd like to at least understand what is it that I can afford, to help direct them in their shopping experience, and at the very least, for example, in the auto space, have a idea of what financing they can get before they walk into a dealership. If the financing department can provide them a better result, then so be it. But at least they know what they're walking in with, and so so in part, working directly with a consumer allows you a lot more flexibility, a lot more ability to customize your interaction with the consumer than you would, for example, if you were relying on a third party like an auto dealer or a furniture store or something of that nature, to sort of control and manage the interaction. And so because you have direct interaction with a consumer, you can do a number of things. One is you can get a little bit more information about the consumer that helps drive a more tailored and precise decision and terms that you're willing to work with on the consumer. The other is it allows the consumer the opportunity uh, to contribute data for their own decisioning and their own experience. And so a lot of the times that happens through using tools like smart consent that we have, for example, that enables a consumer to provide access to banking transaction data, utility payment data, maybe even some of their professional experience on social media, for example. So a lot as the space opens up, the consumers are going to have more and more control over data. They also have access to data that is pertinent on their financial stability, their financial capacity, and so allowing them to contribute that information in the interaction, in the credit granting process, will become more and more important as we go forward. And then in those cases where you may not have that direct interaction with a consumer at the outset, there's still going to be times where there's a need to close the deal or get the sale done, and that usually requires verification of income, address, those sorts of components as well, and then the ability to automate that through direct access with the consumer and consent by providing them data can expedite those processes so that, for example, if you're trying to sell a car as a dealer, you're trying to win the deal as a lender, you can get that done in the same day versus having the consumer come back in the next day with more corroborating information and risk that they either go with a different lender or they abandon the purchase altogether.
Okay, well, so at this point, let me close up. We've hit the 10 points. Thank you, Evan and Jeremy. And to the audience, you just heard from two guys who have deep understanding and tons of experience with respect to lending and automation. I hope you enjoyed the topic and learned a thing or two from the dialogue. Namely, automation of underwriting is not a trivial undertaking. There are many, many considerations and options. For further information on this topic or any general discussion with us, feel free to visit our website, www.trustscience.com, or feel free to reach out to Evan, Jeremy, or myself. Until next time, all the best.
Thank you.